Hello, welcome to Introduction to Business Finance, Chapter 15, Entity Valuation MiniHelp. I put together this MiniHelp because I've noticed that some students are having a little trouble figuring out when we're valuing an entity for shareholders or owners versus when we're valuing an entity for all stakeholders, which would include shareholders and lenders on the one hand, and on the other hand, when we're looking at a perpetuity situation where the business is going to go on in steady state forever and you're going to enjoy that forever, or if we're in what we call a buy, manage, sell situation, which would be a typical private equity firm type of situation. And then finally, I've noticed there's some trouble figuring out which formulas to apply in each of those four cases. So with that, let's get started and see if we can straighten it all out real quickly. Okay, so we learned in Chapter 15 how to value entities operating in a steady state. All of the cases that we looked at were for entities operating in a steady state. And sometimes, most of the time, we did change the target entity's capital structure when we would get involved. In other words, if we were just considering shareholders, it would be when we bought all of the stock. And if we were looking at all stakeholders, it would be when we bought all of the stock and the current debt was called in, and we, our lending team, would issue new debt to the company. So another way of saying that is that we would change the leverage ratio, or the D over D plus E ratio. And we created valuations for four cases. So the first was the value of perpetuity situations to owners, and that's where we used the simple dividend discount model. And then next up, we looked at value to owners for the buy, manage, sell case. It's still a steady state entity, but we're going to buy it when market conditions are really bad, operate it for a while, sell it when market conditions measured by something like PE ratios are really good, and we'll make a bunch of money that way. That, again, is the typical private equity kind of case. And then thirdly, we looked at here the value of perpetuity entities from the perspective of all stakeholders. So that would be our owner-lender team, which I sometimes called for short our D plus E team. And then finally, we looked at the value to an owner-lender team, all stakeholders, for the buy, manage, sell case. So that adds up to four cases that we looked at. And we have general formulas to compute the NPV for the project. Should we buy all the stock of this firm if we're looking at shareholders, or should we take control of the company by buying all the stock and taking control of all the debt if we're looking to all stakeholders? So for equity holders, where we're dealing with E, value to equity, we had a formula for NPV for this project, evaluating should we buy this project. And in this case, we'd be buying it forever. So our cash flows are what we pay for all the shares initially. And then just the present value of every stinking cash flow we would get for the company from that. And this general formulation could work for a perpetuity or a buy, manage, sell. And then similarly, we looked at the NPV we would get for all stakeholders, and that gave us something like this. So now we have PPD plus E, and that represents buying 100% of the shares, and if there is any existing debt, repaying that existing debt. And then again, now we have to look at the free cash flows to the shareholders and the lenders out for as long as the debt equity team is involved in this project. And one thing people say in finance a lot is that we're considering the cost to purchase all the equity and the debt when there's a change of control put. It's true with most companies. If they have some debt out there and the company is being taken over, the debt holders have the right to make all that debt be due and payable at the time of transfer, because let's face it, they might not like the new management. So that's what's called a change of control put, and that would be in any bond or loan contract that the company has outstanding. Okay, so let's take a look at the value of a perpetuity entity situation to owners. And to suss that out, we used what I've been calling the simple dividend discount model. And we contrasted that a little bit with the Gordon growth model, which we did not cover numerically. Okay, so in this case, the present value of all the future cash flows to the owners is going to be annual net income divided by our equity cost of capital. In general, our free cash flow to owners in any given year came from this fairly complicated formula. But really, if you recall what went on in financial accounting, this really just comes from the indirect cash flow statement. So the free cash flow that's available to owners in any year is equal to this whole mess. And if we have a steady state company, everything cancels out except for net income. So the free cash flow in any given year I is going to be constant, and that's going to be equal to net income. And we want to be careful to compute the net income not in the company's existing pre-purchase state, but we want to compute the annual net income after we've recapitalized it, right? After we've set our D over D plus E ratio the way that we wanted. And the price paid by our new shareholders at the time that we're buying the firm is called PPE, and that PPE is equal to the asking price of the equity times our adjustment. This is our equity over debt plus equity ratio after recapitalization. And to pay off the rest of the asking price to purchase the remaining shares, the target company is going to take out a loan at the time of the transaction, and the proceeds of that loan pay the existing shareholders for the rest of their shares. And with all this information in our back pocket, we have the formula for the NPV for this project being, should we, equity holders only, should we buy 100% of the shares of this company, possibly recapitalize it, and then enjoy its free cash flows forever? Remember, we're doing perpetuity here, so this is the forever case. And here's our simple equation for the NPV. The NPV for this project is the amount of money that we're going to have to spend to purchase some of the shares, the existing shares right now. And again, that probably won't be 100% of the shares, plus the net income. And this is the post-recap net income divided by our cost of capital. So that's pretty much it for valuing a perpetuity situation entity for shareholders only. Next up, let's look at valuing a perpetuity entity to our DE team. So our DE team, debt equity team, would be the same as all stakeholders. Remember, in finance, we consider our stakeholders as owners, stockholders, and lenders, which could be bank loans or could be bonds, either one. Okay, so in this case, the present value of all future cash flows to the team, the owner and lender team, is equal to our NOPAT divided by our weighted average cost of capital. And similarly here, we got this simple present value formula from sort of a big mess. That in general, the free cash flow available to lenders and owners is equal to NOPAT plus this minus that, et cetera, et cetera. And if we have a steady state company, the sales aren't growing, none of the costs are changing, anything like that, every term drops out except for NOPAT. And one other thing that's good to remember here is that NOPAT is equal to EBIT times 1 minus the tax rate. So on something like a final exam, I might not give you NOPAT, but I would give you EBIT and the tax rate, and it would be good to know how to compute NOPAT from those two things. And again here for our steady state firm, when all these other terms drop out, our free cash flow available to all stakeholders in any given year is constant, and it's equal to NOPAT. And just as was the case with net income, we want to compute our NOPAT in the entity's recapitalized state, the way that we're going to recapitalize it. And in this case, the amount of cash that has to be coughed up to take control of the firm for the whole team is called P sub P D plus E, and that's the price that the team has to come up with to buy all the firm's equity and pay off all its debt. Remember that control put, that termination of control put that we talked about. Okay, and to take control of the firm's debt and equity, the equity portion is going to look like this. So if you're a private equity firm, the amount of money that's going to come out of your firm to take over this company is the total amount of money that has to be coughed up to get rid of the previous owners and lenders times E over D plus E, right? The target company is going to take out a loan of the total amount required to take over the company times D over D plus E, and that's going to be made, that loan is going to be made by the lending portion of the team to the entity that's being taken over. So the entity that's being taken over will be levered up. And once we have that all in our back pocket, now we have our NPV equation for this project. This project being, should our team, our debt equity team, consider taking over full control of this company, buying all the shares of stock, paying off any debt if there is any, and then recapitalizing it with the D over D plus E ratio that we want, and enjoying the free cash flows forever. So what's going to happen here? So we have to cough up, one way or another, enough cash to buy all the shares and pay off all the existing debt. That's what's going on here with P sub P D plus E. And then the future cash flows that we're going to get, the present value of the future cash flows we're going to get, is just annual NOPAT. And remember, that's constant every year because these are all steady state entities. Annual NOPAT divided by the cost of capital, weighted average debt plus equity. And one other thing, let me just put up here quickly, is that E is equal to 1 minus D. Okay, so the percent of equity we're putting into this deal and the percent of debt have to add up to 100%. Okay, so next up, let's look at valuing steady state entities for owners in a purchase, manage, sell situation. So this would be the type of thing that many hedge funds do, some private equity firms do, and they'll say market conditions are horrible. This is a great company. Let's buy it. Let's own it for a while. Let's sell it when market conditions are better and we can get a higher price for it. So the general NPV to owners only in this case is going to be the amount of money we have to cough up to purchase all the shares. And then that's our negative cash flow at T equals 0. And then we're going to enjoy the future operating cash flows thrown off by the firm. Sorry, not operating cash flows, the free cash flows thrown off by the firm for the number of years that we own it, up to N. And of course, each one of those cash flows we have to discount back to T equals 0. So we have apples versus apples here. Okay, and then finally, at the end of year N, right after we receive that year-end free cash flow. So we get the year-end free cash flow. 1 nanosecond later, we sell the firm for this price, SP, comma E, and of course we have to discount that cash flow back to T equals 0. So we've got apples, apples, apples here. PPE, to be clear, that's the portion of the purchase price that's going to be paid by the new owner. So if we're looking at an entity that has no debt at all, we're probably not going to be paying the whole asking price from our own funds, because we know that if a project is worth doing, it's worth levering. So we're going to spend some fraction of the total asking price from our fund. So that'll be the total asking price times E over D plus E. And how is the rest of the money going to be obtained to pay off all the prior shareholders? As usual, the target company is going to take out a loan at the time of the transaction, and the proceeds of that loans are going to go to the previous shareholders to make up the rest of the purchase price. Okay, and the free cash flow EI is the free cash flow that comes out in dividends to owners from the entity's operations in that year. And as we know, for our steady state companies, right, the free cash flow in any given year is constant and it's equal to net income. N is our last year again of owning, managing the firm. And again, our SPE is the sale proceeds to owners at end of YN after year ends cash flow. Let's even say net income. And last up here, let's considering our fourth case, which is valuing steady state entities for the debt equity team or for all stakeholders using now the purchase manage sell model. So let's consider the purchase price for everyone. That is the market's view of the enterprise value, what we call the enterprise value. So what's that got to be? For full control of the firm, we have to buy all the stock, okay, which is what? It's just the price per share of the stock times the number of shares outstanding. And then to take full control of the firm, so we've got it free and clear, we also have to repay all the existing debt. And so just taking these two things, this is available in the marketplace. This is available, it's a little bit harder to look up, but it's available at places like Bloomberg, et cetera. And it's also on the company's annual financial statements. And so that's the market's view of our enterprise value. And it's also the amount of money that the team is going to have to cough up to take full control of this entity. So we want to compare that with our view of the enterprise value. And we want to see if our view, as usual, is higher than the market's, then we probably want to go ahead with this deal. And if not, then we probably don't. So our view of the enterprise value in general is going to be the sum of each year's NOPAT for which we're owning and controlling the company, each one individually discounted back to T equal 0, plus the sales price, which is going to include equity and debt, because we'll call in the loans at that point, the loans and or the bonds, when we get rid of our position in this firm, our control of this firm. And so that also has to be discounted back to T equal 0. And let's make sure I've talked about all the terms in here. So the NOPAT is equal to the free cash flow available to all the stakeholders in any given year I, because we're in a steady state company. This, which could be a very complicated thing to compute, turns out to something simple to compute. NOPAT, which again is equal to EBIT times 1 minus the tax rate. And those are the free cash flows available to the entire team, the debt group in our team and the equity group in our team. Just as we wanted to with net income, we want to compute our NOPAT after we have recapitalized the firm at T equals 0. And our SPD plus E is going to be our total cash received when we exit this project from the sale of all the stock and calling in the loans or bonds at TN. And so with all that in our pocket, the NPV of this project for the entire team, the debt and equity team, is simply total purchase control price that we're going to have to pay at T equals 0. That's why that is negative. And plus the enterprise value, our estimate, team's estimate. And as usual with NPV, if this is greater than 0, we want to go ahead with the project. And if it is, we'll say in this class 0 or less than 0, we don't want to go ahead with the project. And another way of saying this is that if our estimate of enterprise value of the firm is greater than the market's view, of the enterprise value of the firm, we should go ahead with the project, and otherwise not. So I hope this has helped clear up some confusion that I've seen in office hours and also the discussion forums on the Chapter 15 material. And I look forward to speaking to you again very soon. Take care.